Yes. Right. Alright, those that just joined us, welcome. We'll go through some chart updates in just a second. Obviously today is non-farm payroll, so do bear that in mind. Should get some decent movements. But yeah, let's see what's looking good to take. We tried to take a short on oil this morning. Pushed back up. We got out of break even. But apart from that, really, it's been a little bit cooling off. Markets are kind of quickly changing from the narrative from a couple of days ago, and holding off ever so slightly for this non-farm payrolls report. So yeah, let's see what we can get. Obviously, we did get some data coming out throughout today and yesterday. Yeah, we got 30 minutes and then we got that data coming through. So we'll have a quick scout across the boards, see what we can get involved in. Okay, oil. Let's go from top to bottom anyway. Pushed all the way back up to liquidity. Okay. Seeing whether we can get in on a short. Not going to go too excessive in terms of targets, but maybe we can get down to this area again. Or maybe we can even get a little bit lower. It's a little bit here. Yeah, I mean, it's tapped supply quite nicely. Not getting much of a follow through. That's the only thing. But I guess the main thing to take in is that we are at a strong level of supply, as you can see here. It was a very nice rebound. Very nice rebound indeed. Yeah, see, I'm just looking at potentially just taking it straight to the structure here. It's a potential, got potential head and shoulders, yeah. Literally just play it to the top right there. It's not too bad. It's not too bad. Good morning, Casey. How you doing, my man? You ready for non-farm payrolls today? I don't mind taking a potential short here. All of this, yeah. Probably just pop it a little bit higher. Let's go there. Nice supply here. Right, I'm going to take this short here. And then we can dive back in. In terms of gold, I'll go through the chart in just a second. But it's looking very awkward. Yesterday, I mean, you'll see it from the price section, is extremely choppy. Extremely choppy. let's go to there. Okay, 3.5. Yeah, let's take it. Okay. Okay, gold. Let me just pop that there. Sweet. Okay. Yeah, gold is a very strange one. Okay, it's entered the range. It could potentially be putting the bottom in. It could also break and breach and come down to this area of liquidity as demand, and actually see that push. And you're seeing a bit of a push down lower right now. But yeah, I mean, you can see from this, it was just a very choppy day yesterday. Lots of ups, lots of downs. But yeah, just moving and staying within this range currently. Getting a little bit of this supply coming in here, as you can see. So, I mean, it could be the case that we break through the structure and come down here. And we'll see how things kind of react. It could be the case that, okay, we break and come down here and maybe start putting the bottom in, or see a large reaction straight back into structure and back past this top of the range. So essentially a fake out. It's a pretty strong area for demand, so please do bear that in mind. We won't be getting involved in this. We're just going to let the price action play out. It's not really ideal. As mentioned, it could breach, find strong demand from this area and push straight back into structure to this unmitigated supply area just here. So just bear that in mind. Okay, so we're just letting it play out today. We'll go and tackle gold next week once we get a little bit of structure forming throughout the course of today. But yeah, that's your structure. Now, US dollar, Japanese yen went to our target. Again, lots of choppiness yesterday, so we got stopped out. But yeah, it came down to this area here. So yeah, it's pushing back up for the day, holding somewhat of a range. Let me just get this a bit better. As you can see, could be the case that we actually break through trend, come back down, test this swing low down here. There's a little bit of demand just here, as you can see. But yeah, it's a bit of an awkward one today. Trying to kind of predict which direction the dollar is going to go into, because we did see a bit of a push back down to structure just here, as you can see. And back up. There's a bit more demand a little bit lower down. Again, I mean, we've broken through here. We can get rid of all of this, there's no need. Just shy of this area, so it might be the case that we continue holding through structure and actually push into that area for supply. Maybe come back down, push in, and then see a larger move down. It's not really kind of clear in terms of the structure that it's putting in. Obviously, we are in a bull trend at the moment, well, on this move anyway. But yeah, I would like to have this area tested a bit nicer. Otherwise, we will just be moving within this structure here, just holding. Yeah, it could be the case that, okay, push, come retest, hold, and then continue moving back up. Go for that test of that swing high right there. Yeah. Euro dollar. Okay. just ever so slightly shy of this area of supply here. Okay, could be a case that it's enough. We've got the trend line. It's been holding for a decent amount of time, but it looks like we're putting in a little bit of a bottom here. So it could be the case that we break and push up higher. Very much could be the case. Break through trend line, push up higher. Seeing a decent amount of buy side came in here. Relatively weak sell side. Yeah. So we either stop, break, push, or push from here. It's a bit of a difficult one today, guys. But yeah, if you guys are looking at anything, let me know. In terms of crypto, it's very clear. Range. It's kind of exactly what you get in the spring action on the Wyckoff theorem. Okay, we got that initial break, push back down, see that demand coming in, spring back up, all the way to liquidity, straight back down. So we're on the tighter range just here within the wider range. Okay, as seen. So maybe we come back down, fill in, or we can push back up. Okay, it really does depend on what the non-farm payrolls figure is today. It could move it, it could not move it. Okay, we should get a little bit more clearance going into next week, which would be nice. But yeah, very much within a range. You got Bitcoin dominance slightly up as well. So if we get a move to the downside, some of these alts are going to bleed or continue bleeding because they have been bleeding for a while now. But yeah, we've got initial breaker structure here, so we could be pushing right back up. A little bit of structure here as well. Yeah, all eyes on the dollar, that's for sure. That's what we got our eyes on. It's a difficult one, it's a difficult one. Okay, we've got 16 minutes until this data. Yeah, we're not going to go too crazy on trades prior to this figure. So we've got involved here on oil. We'll see how it plays out. But yeah, we'll let markets kind of digest the non-farm payrolls, average earnings, unemployment, all of that good stuff, and then we can dive into some trading. But yeah, even yesterday's trading was a bit iffy. Get rid of this little stuff. Yeah, don't need that. Gold 30 minutes, short price target 1929. Yeah, it's potential. I just don't like the structure of gold right now. Get rid of this. Yeah, I don't like it. Especially after yesterday's price action. I'll take another look at it, but I think I'm just gonna let it play out. So we got that range popped in there. Got your bottom structure here. Got a decent liquidity pool just here. The only thing you need to be careful of that fake out playing out, bam. It's very close to that liquidity area here. There's your structure, there's your low. So it could be a case you breach straight in, maybe 1926 just above, and straight back into structure. So you just need to be careful. But yeah, I mean, look at all of that choppiness yesterday. It's just a dangerous one, it really is. But yeah, I'm gonna let it play out a little bit longer. But it's likely that we just tackle it next week. It's just very awkward structure right now. Let's get some radio on anyway.
That's really the key to the long-term growth and long-term job growth is investment, because without investment, without the capital goods and technology for people to work with, you're not going to have high employment, you're not going to have productivity growth, you're not going to have overall economic growth. So that's crucial. Obviously, as the hurdle rates get higher and higher, as the Fed raises rates, and also as inflation comes down, and so that the real rate, that is the inflation, goes up, that may put a little bit of a crimp in investment going forward.
I want you to look at almost a societal view with the leadership of the late Gary Becker Friedman at the University of Chicago. What is the 3-month moving average non-farm payroll statistic where you can say there's a societal angst? Is it 170? Is it under 100,000? What's the statistic that begins to signify labor pain?
I think it's not just that piece, it's a combination of things. It's labor force participation, and we've seen workers that for older workers and younger workers still not quite where it was before. And
Come on, Bitcoin, sell off.
But how much are you making when you have that job? Are you able to afford to put food on the table for your family? So you could be working really hard, but if your real wage is going down, that is your inflation-adjusted wage is going down. They're not paying enough. So you really have to make sure that you get the balance right. You've got jobs that are generating real wage growth, and that there are enough jobs that people can
Okay.
can
All right, 10 minutes out.
their families deal with their families well.
So we were talking earlier, Randy, and Tom brought this up about the dual mandate of the Federal Reserve. And it seemed like for a while there, certainly during Jackson Hole last year, there was one mandate.
All right, let's get this stop loss to break even. Okay, we're not taking any unnecessary risks, yeah.
We have the possibility of a soft landing and we don't want to kill it. How important is that to them to preserve this kind of strength that we continue to see as long as inflation keeps coming down, even if not to 2%?
I think you're exactly right. I mean, they have gotten this gift. I don't think anyone a year ago at the Fed or really anyone else thought that, we've got this perfect way of doing things. We can have this immaculate disinflation with the inflation rate coming down significantly without the unemployment rate going up. That's not what the law would say. We seem to be moving in that direction. I still don't think we're, I'd say 100%.
It's going to be an interesting one.
But there's more evidence of that, and the Fed would like to preserve that for sure. As I said before, the ideal is to have continued job growth at a sustainable level with good real wage growth, and we're starting to see real wage growth. Inflation rate has come down very significantly. Wage growth is still is now above that.
Hopefully it pulls through and we can cash in.
To make sure that we don't have inflation persist, but we're getting into a better situation than we were before.
Given the fact that there is this emphasis on trying to get the sort of the hope of the soft landing, how much are you looking for some sort of tacit admission by the Fed that it is not important to get inflation down to 2% in the near term over the next few years?
Oh, they're not going to suggest that in any way, because their view is that in the both in the intermediate and longer run, that if you have high inflation,
Very close. Very, very, very close.
Good, strong wage growth. You're not going to have a strong economy, and that's ultimately what they want. And so I think they're going to continue to say our key mission, our priority right now is to make sure that we get towards our target. Then the question will be, once they get close enough, what they said they will sort of maybe.
Am I the only one seeing a possible buy?
Sustainable path to.
Yeah, I mean it's a potential. I'm not saying it's not a potential.
We'll see how that plays out over the next year.
Yeah, I mean after this price action from yesterday, what I'm looking at potentially playing out is a very quick dip into this liquidity pool here, and then straight back into structure. That's a potential. That's why I'm not getting involved. You do have that potential of that fake out to the bottom end and then straight back into structure. But yeah, we're just moving within this range at the moment. It could be the case that we just push straight back up from here. Okay, we're kind of sitting at limbo right now, so it's not really ideal.
The Fed is going to be relatively happy about the number today.
You get the feeling that next week's CPI report is a little bit more important than this jobs report that people are expecting to come in a few minutes' time.
But yeah,
I think so. In terms of
our target that we were looking at, gold moving to, was 126. Literally just as soon as we tap into this pool.
two CPI reports, you get a PCE report.
So
you're a little bit less
not far off it,
on
but
the number today and next week. But when we get to September,
it's a very awkward price action.
Because that's really going to be determinative. They want to see a trend, not just a data.
Yeah, so I mean we could get that dip straight back into structure.
Lots of nuances here.
Well, I thought
Just
it
need
was
to be
interesting
careful of
because
it.
there is a shortage of lifeguards out there because you can't find people to work, and a lot of cities are reporting they can't open their municipal swimming pools because there aren't enough people to work
Is that a thing?
as lifeguards.
Wow.
But I think
We
at this
go
point,
up and we go down.
still
Okay, we're 5 minutes away from this non-farm payrolls.
the question is, does that continue to produce inflation, or do we get that Goldilocks scenario that they're just a soft landing?
So much of this hiring has been in the services sector. How much do you expect that to continue to demonstrate that type of increase, that type of acceleration at a time when the ISM that we got yesterday was more subdued?
You can't say never, given the way that the economy has developed over the last 2 years, but you have to think services are going to continue. Everything is telling us, even the ISM number yesterday is telling us that services are still hiring and still looking for people, whereas manufacturing, there are a lot of mixed messages out there about whether we're going to see a decline in manufacturing jobs because we've seen a lot of slowing in manufacturing, but then we see all this construction work going on. It's really hard to tell, but
Exactly, the limbo state gold is in and showing me a strong resistance.
Just quickly, any Fed speak after this? We need to pay attention
Yeah,
to.
we should ask.
it's a potential play out for sure.
With Austin
For sure.
Chicago Fed president in the 10 o'clock hour, and then we'll be talking with Raphael Boston.
It wouldn't surprise me if it pushed straight back up. Not at all.
Just to tee you up.
Thank you.
The jobs report coming up next with equity futures on the S&P 500
Really wouldn't.
just about positive. The number we're looking for, if you're just tuning in, just for you, for everyone else. I'm sorry I'm doing this again. 200,000 is your median estimate in our survey. That number on repeat this morning. 200k. That's the number we're looking for. The jobs report.
You know, a decent amount of volume coming in on there as well, holding things up. So it could be a similar price action to what you got here on Bitcoin, where you kind of have a range essentially, and you dip just past that bottom, and then straight in.
Welcome to freedom of flexibility. Welcome to Commonwealth. To learn more, visit commonwealth.com. Commonwealth Financial
It's one of them.
Member FINRA.
I'm just gonna let it play out. It's Friday anyway, guys. So just let it do its thing.
Build an awesome terrarium. Cut a large plastic bottle in half and fill the base with sand, pebbles, potting soil, and your favorite plant. I chose an African violet. Put the top of the bottle over your base and place it in the sun. Your plant will grow sealed in its own ecosystem. Fun, right? Learn more at She Can STEM. A message from the Ad Council.
When news breaks across the globe, Bloomberg Radio is there. From Asia
China's economy grew more slowly than expected in the second quarter.
to Europe
NATO has moved forward with plans to enlarge its defense alliance.
and anywhere in the world news happens.
Bloomberg's Anne-Marie on the ground in Lithuania.
Bloomberg's Stephen Engel has the latest from Hong Kong. Joining us from Bangkok, Bloomberg's Chief International.
Very awkward price action today. Very awkward.
Coverage from Budapest.
Bloomberg Radio on the ground.
Alright, we're out break even here.
You took the first step and quit smoking, but even former smokers may still be at risk for lung cancer. That's why SleepAndScan.org wants you to know about a new low-dose CT scan.
Very choppy today. Very choppy.
Visit SafeByTheScan.org for a simple quiz to see if you're eligible and talk to your doctor about screening. SafeByTheScan.org is brought to you by the American Lung Association's Lung Force Initiative and the Ad Council.
The market's in focus every business day. The Tape Podcast with Paul Sweeney.
Are there some sectors that you want to have more or less exposure to? How concerned are you that this labor market may start to show some cracks?
Analysis of the day's Wall Street action.
What do you make of this regional bank business these days?
From Bloomberg Intelligence, Bloomberg Opinion, and influential newsmakers.
It's just a headline coming across the tape here.
The Tape with Paul Sweeney. Subscribe today on Apple, Spotify, and wherever you get your podcasts.
Chainalysis is the premier blockchain data platform. Crypto businesses, financial institutions, and government agencies utilize Chainalysis data and services to make sense of what's happening on the blockchain. As regulators and policymakers work together to pass legislation that provides clarity for crypto businesses and protects consumers, they have the chance to do so with unparalleled data and research.
Yeah, just let that non-farm payrolls come out,
Cryptocurrency and gain greater
and then we can go in again.
Chainalysis.com/radio.
Adopt US Kids presents What to Expect When You're Expecting. teenager. Learning the lingo.
Jelly. Jelly adjective. Jelly is a shorter, better way to say jealous. As in, Chloe, I am like so jelly of your unicorn phone case.
You don't have to speak teen to be a perfect parent.
Okay, what does it come out? Average earnings month on month, stock. Stock the same. Non-farm payrolls, 187.
Your jobs report seconds away.
It's nothing crazy.
Bond investors, they want a vacation after this week. Wall Street wants this number to be a total snooze. We'll see if it is. Your equity market on the S&P 500 positive by 0.2%. Yields higher for a fifth consecutive day by a basis point on a 10-year flat. 38. The jobs report, the estimate 200k. The number with Mike McKee. Good morning, Mike.
Good morning, John. It's a snoozer. All right, everybody, turn off your alarms. 187,000. That's a bit of a surprise because it comes in lower than anticipated and certainly down from
It's nothing crazy.
Initial read. I'm waiting for the revisions to drop. Private payrolls up 172. That is down from the forecast of 180. It was only 149 last time, but interesting because the 83 number was so
we're at that.
and this compares with that. 49,000 jobs.
We're at that demand zone now. It's a good thing that we got our break even here as well.
A shortage of jobs that will help.
I like it. I like it.
The market is slowing down. Unemployment, though, 3.5%.
And you got, see, you got that dip. What did we say? Literally played out exactly to what we said, guys. Literally said. Straight dip, 1926. Straight back into structure.
By a tenth. So that is maybe a sign the economy is slowing a little bit. Labor force participation unchanged at 62.6, and the youth 6 number, the underemployment rate 6.7%. The prior month of July was revised down to 185 from 209. So that's going to be the weakest in some time. And the change in private payrolls revised down to 128 from 149.
So in the market right now, Mike, I would say there's a bit of a tug of war.
So let things do their thing, settle a little bit, and then we can go.
Reduction in hours work, competing with still hot wage growth, which comes in just a little bit hotter than expected at 0.4.
Yeah, and did the dip and down movement, literally exactly what we said. We literally said it. Into that liquidity pool and straight back in.
Yields fade at the front end, so the 2-year was a bit higher by 3 or 4 basis points through this morning, now up by only 1 basis point to 4.89, and the dollar a touch weaker against a stronger euro dollar 109.69.
I like the supply coming in here. I like it.
More for us. It's a downside surprise on payrolls, but wages come in a little hotter, and unemployment drops to 3.5%.
Yeah, this is why the Fed is going to hold off and not look at one data point, because we've seen some numbers that suggest that maybe the labor market is getting a little bit looser, but then you look at the unemployment rate and you're looking at a problem for the Fed, because if that's what's driving up wages or keeping them higher, then they're not going to make the progress they want to make. They're looking at this as the labor market loosens, it's easier to find workers, and then we don't have to pay them as much. But it doesn't look like much has changed over the last month.
I look here, Mike, and it gets me back to Q4 of 2019. If I take out the gyrations of 2020, all the COVID emotion that was there, all of a sudden with the revision, 209,
Yeah, and in terms of the dollar, potentially push now. I mean, we tapped this demand zone here, seeing some nice demand coming in at the moment. We got this high that we need to break through. If we can get up and above, maybe we dip into this area here for supply, back down, hold, and continue pushing back up.
If we were looking at it in July of 2019,
Really wasn't much.
so now we think, this is the weakest since the pandemic.
I mean,
The weakest
average hourly earnings 4.4%, same as previous, so literally no change. Non-farm payrolls 187. I mean, it's still above previous, but lower than forecasted.
So
So I mean, it's nothing crazy.
Mike Collins,
Nothing crazy today.
Also of iCapital. And we'll do a bit of Apple in the mix as well with Angelo Zeno of CFRA TK. All of that still to come.
March 8th, the 5% of 2-year yield up now 2 basis points, 4.90%, and you wonder here if we get to visit 5% here with the mix of jumble that we see here. Governor of the Federal Reserve System, Jeff Rosenberg, as well from BlackRock. Governor, I'd like to go to you right now. I was talking to Mike McKee about how we allude back to pre-COVID. Are we beyond COVID? Is this a jobs report now that really begins to feel like Q4 of 2019?
I think that's right. And exactly as Mike had said, this is still a pretty strong report. If you put it into the bigger picture context of how much job growth we've had, you still have an unemployment rate that is, at or near its 50-year lows. And I think the hawks and the Fed are really going to focus in on the wage growth. And that's going to be the real.
Well, that's supply coming in here. So
Inflation can be difficult to bring down in a sustainable.
I'm not sure if I should hold the buy because I have no confidence in the movement. Yeah. Depends where you entered, really, mate. If you entered on this dip here, then probably just hold, see how it plays out. Maybe just have the target either at this point or within this area.
But we are seeing the number come down, and that's a good thing.
But that's a decent reaction from the buyers. So it's a very strong reaction here. So I wouldn't be surprised if we even kind of blow through this. I would not be surprised. It's a very strong reaction from the buyers there.
Persisting at the rate that it was, and unless we get a real boom in productivity, and last week,
yeah, it's a strong reaction. And you got some buy side support from this movement yesterday as well, and you got it here.
ChatGPT and AI is going to
Yeah, I'd hold it, mate. I would hold.
productivity boom, allow real wages to be growing, and we can bring inflation down. That's the true Goldilocks scenario.
But yeah, I mean, you got that fake out straight back up.
Thank you so much for joining us.
So a whole load of buyers getting involved on this movement, anticipating the breakout from this range. Got tapped out. And now you're getting the reversal on the other end, and now you're getting the shorters that got brought into the trade on this breakout, tapped out. I'd hold it. It's pretty decent. Pretty decent.
There are some mixed comments, as Jonathan was just talking about, between the wages, but the headline is really a story of gradual labor market normalization. And gradual labor market normalization basically continues the market expectation that the hike of the last meeting was the last hike. And that's the big change in the yield.
That initial break.
Is that we're seeing the effects of normalization in the labor market. Yes, wages will follow.
Unlucky.
Maybe not. That remains the uncertainty. But you look at the ECI report, you look at some of the other broader reports, what do they show you? They show a gradual slowing in wage inflation. And so that feeds into this narrative that the Fed can be done, they can wait. And so for the yield outlook, it's really about the shape of the curve. What we saw this week, the steepening, and I think that remains to be the message that's our main focus in terms of our position.
Right, I'm going to take a short here on oil.
Gives you the most information right
Taking it
now.
short.
Comparison of two yields.
Let's go for it again.
You can look at lots of different measures. We tend to like the five-year forward. It's a nice measure. It captures both the level and the shape of the curve, and it's moving. And we've seen a significant move this week, and for good reason. The back end of the curve is definitely a bit more challenged when you look at historic levels of five-year forward. If you look at it, if you're showing here on we look at the 2s10 spread. And I think that's really where the market pricing is a little bit vulnerable. When we look at all of the information that we saw come out this week, and away from kind of the monetary policy focus, it's really about fiscal policy. We had the refunding announcement.
It's not the most ideal risk reward, just because we do need to keep it above that point.
And that's, I think, the vulnerability that we're looking at.
Jeff, I have to go back to something that you're saying, that what people are basically assuming is the Fed is done. They're not going to raise rates more. And that's what you're seeing today, where there's a little bit of a move at the front end, but really the move that you're seeing is at the 10-year yield, once again reaching 4.2%, the highest levels going back to November. This is the key question. Is the Fed going to take their foot off the brake at a time when we're still seeing wages go up? Is that basically the assumption of markets now looking at a Fed comfortable with 3% inflation over a longer period of time and not needing to get down to 2% so quickly?
Well, it's a really good question, Lisa. What does taking the foot off the brake mean? Does it mean not doing another hike that they signaled last meeting 2 meetings ago, or does it mean just simply leaving rates unchanged? Or does it mean, as the bond market is anticipating, that they move to cutting interest rates? And I think as we progress this debate, we're going to increasingly talk not about the next Fed hike, but how much inflation decline, if we continue to see that decline, how much inflation decline do you need to see before the Fed has to start cutting rates? Because as inflation declines and the Fed stays pat, real interest rates, the real Fed funds rate, which is the transmission mechanism for monetary policy, that begins to actually increase. So how much actual breaking does the Fed tolerate, not by their action, but by further declines in interest rates? And that's going to be the metric that Powell's really telling you about in the press conference from last week. That was really the story, is that as inflation comes down, their policy gets tighter. And how willing are they going to be to see that tightening in policy? Again, this is all predicated on this expectation that we'll continue to see further declines in inflation. And obviously, if that changes, the whole story changes. But that is kind of the natural breaking that occurs without the Fed having to do anything.
Just quickly here, Jeff, it seems like there's been a narrative shift over the past couple of weeks where higher for longer is more acceptable, as well as a soft landing type of scenario. How much are you leaning into this and adjusting your expectation of yields being higher for longer, but also risk assets continuing to chug along in the meantime?
Yeah, I mean, part of the problem with adjusting too much is that the market pricing for so many risky assets is already there. So when you look at, is there a lot of opportunity in credit markets, for example, for the soft landing being realized, you see that you're pricing in many cases mid-expansion type levels for expectations. You look at the high yield bond market, for example, it has been on a tightening tear. It has never really reflected the same degree of recession fears, recession probabilities that you see, say, the consensus economics profession now, moving away from, pushing down recession probabilities. We never really had that priced into the credit markets, this huge disconnect between, the SLOOS, the credit indications in the surveys and what's priced in the market. So there is an opportunity. It's really about carry rather than price appreciation.
Come on.
Appreciation already happened off of the November lows.
Give me some red.
Jeff Rosenberg, thank you so much with BlackRock this morning. Greatly appreciate it. Here off the jobs report. Lisa, are you with me here that we got a bid to the market? I mean, we want to go down. I see some red on the screen, then we come back with a little bit. It's a fractional lift, but we're going to snooze fest. It's genuine.
What I would say is I want to build on what John was talking about, the tug of war between the headline rate that was below expectation and then the wage number that came in stronger than expected. And what I feel right now in markets is the wages is actually winning out. It is dragging down an index that initially popped, and it is pushing up yields, particularly in the 10-year space. And to me,
Interesting.
You have still that inflationary pressure, even if on a headline number, you're seeing that normalization.
Yeah, we haven't talked enough about this. I'm going to look at the real yield here at 1.80%, 1.81%, which is a long way a higher statistic there than what we saw 2-3 weeks ago. As well, diving into the data, I'm looking over here, folks. It's like in fourth grade when you look over at the smart guy and say, "What's he looking at?" It's like 18 columns. with 75 rows of data. What's a number on that screen, Mike McKee, that matters?
As long as I can still read that tiny thing.
I can't read it.
I'm not old yet. The numbers that matter, of course, today is the unemployment rate and the hourly earnings numbers. And the unemployment rate comes about because we had 268,000 additional workers in the household survey, and we counted negative 116,000 that lost employment during the month. So a big difference there that puts the unemployment rate down to 3.5%. When you look through the overall list of jobs, the two things stand out. One is that the changes are small. For most categories, they're either plus 100 or plus 1,000 or down 1,000 or something like that, as opposed to gaining 10s and 20s.
Anything on lifeguards?
I don't see lifeguards in there, but that's probably under amusement parks, and we can look at that. But the other thing is that the biggest job-losing category is at management of companies and enterprises. And this has been a story that companies are holding on to their lower-skilled laborers because they're afraid they can't find them anymore, and they've been right-sizing or rationalizing their expenses by getting rid of layers of management. And so we do seem to be seeing a little of that in there.
Mike McKee, he'll interpret this through the 9 o'clock hour on radio and television as well. Right now, on this Jobs Day, with all that we see in the markets, futures up, fractionally up as well. Without question, the conversation of the day on having the courage to be in this market, given the sum of all our fears. Edward Yardeni joins us, president of Yardeni Research. I can't say enough about his prescience once again across many decades in October of last year. Reaffirm, Ed Yardeni, how a bull acts and moves forward given the many fears that are out there.
Well, I've been thinking that we've been in a recession since early last year, as we've discussed before. It's just been a rolling recession. Now I think we're in a rolling recovery. And I think increasingly the markets obviously have discounted that. And the so-called Godot recession still hasn't shown up. It may show up at some point. But with regards to the market, my year-end target for the S&P 500 is 4,600. I got there a few days ago. So I'm thinking I'm not going to raise my target to 4,600. I'm going to keep it there. I think it's going to turn out that the expectations at the beginning of the year was that we would have a pretty lousy first half of the year and a good second half of the year for the market. I think it's going to be the reverse of that. I think we've clearly had a very good first half. And I think the second half is just going to be challenging. I don't think it's going to be a big downer. I think it's going to be kind of sideways. September's coming, and that obviously could create some problems. But by year end, I think we'll be at 4,600, which is where we were a few days ago.
How much are you buying in to this idea that we're going to see higher rates for longer, particularly in duration, in 10-year notes, in 30-year notes?
Well, I've thought that on short-term rates that the Fed was pretty clear what they wanted to do, and I took them at their word. I know there's always skepticism.
No, I've updated that oil trade. I've just widened the SL and CP. Just gonna have to give it a little bit of room to maneuver.
My friends, the bond vigilantes seem to be settling up. I thought we'd hold around 4%, but here we are back at the November high of 4.2%. So it's looking a little dicey on the bond side. And I think
crazy squeeze on either end.
Consideration that while the Fitch rating agencies downgraded the U.S. government debt was sort of the event that focused everybody back on the deficit. The fact of the matter is we've all known that the deficit is a problem. We've known that fiscal policy is profligate. It's just the market cares about it now. So if the market cares about it, I've got to care about it.
At a certain point, Ed, when does the higher rate structure at the long end, at the 10-year, at the 30-year end, not on the short end, threaten your bull thesis?
Well, I think that it already has done its damage in the one area where the rolling recession is hit, and that's in housing. But even there, as we've seen of late, the housing market's holding up pretty well, at least in terms of prices. There is a shortage. The real issue is the consumer. Will higher long-term rates knock down the consumer? And I don't think that's necessarily the case at this point. The consumer obviously depends on a certain amount of consumer debt. But the key is employment, the key is wages. And while employment weakens somewhat, it can always be revised one way or the other. We know that the wage number at 4.4% well exceeded well, let's take it 0.4 because we're doing month to month. So 0.4, we know that it exceeded the CPI, and so real wages are increasing. Consumers have a lot of wealth in their houses. Baby boomers have a lot of wealth. They're retiring and spending it. So all in all, I'm not quite sure how a increase in the bond yield knocks the consumer down, unless we just get some sort of banking crisis event again. As a result of that.
Just quickly then, Ed, how much are you thinking that the Fed has still gone enough, even if we are seeing this sticky inflation and wage pressures?
Well, it looks sticky, but
interesting one today.
To come through. Yesterday we had a remarkable increase in productivity of 3.5%.
Just thinking whether we're going to get a rebound and where we're going to get it.
Employment was flat, which wasn't really the case, as we know, based on the monthly data.
Got this area here.
I think productivity is going to make a comeback, and we may very well see wages rising faster than prices.
And long ago and far away, on a Friday evening, Lou Rukeyser would sit there with you on the couch, and he'd say, what's it look like long term? Modern day long term is 9 months. Maybe it's a year at Yardeni. For the mere mortals watching and listening, where long term is 3 years or 5 years, frame out the growth you see in revenue of our equities. It seems to be pretty darn good, like 6%, 4%, whatever. Give us a Yardeni 3-year perspective.
Well, I actually like to do decade perspectives, and this decade I think started out with all sorts of problems. At the very beginning of the decade, before the pandemic hit, I started talking about a possibility of the roaring 2020s with productivity making a big comeback, and that looked absolutely delusional there for the past couple of years, but it's looking like it might be a reasonable way to think about the rest of the decade, not just AI, but robotics, automation, lots of technologies there that are going to boost productivity. So I think from a revenues perspective, revenues tend to increase along with nominal GDP. If we get a productivity boost here, there's no particular reason why revenues can grow 5 to 8%.
Should we fear the concentration of 7, 8, 9, 10 mega names? The mega names have reported 2 of them in the last 24 hours. How should we interpret the durability of what we see from these names?
Yeah, you gotta just let it do its thing. Wait for the NY volume to start kicking in.
Go on the same roller coaster as everybody else, but if you try to control your emotions, you just have to deal with the facts. And the fact is, we've got, I call them the mega cap 8. We got 8 companies that account for 27% of the market cap of the S&P 500. And they're great companies, as Amazon demonstrated with its latest earnings report. And I think they're going to continue to have an outsized impact on the market capitalization of the market, which means we have to accept that PE is higher because their PE is higher.
Ed Yardeni, thank you so much on a Friday morning. Mr. Yardeni, Yardeni Research there, and he reconfirms 4,600 SPX right now, 4,537. So Lisa, I guess Yardeni's saying, sell in August or take a nap in August and come back in January. Well, Lisa, I look at the bond market here. I want to reframe this because I don't think we've talked enough about it today. I got a real yield. I got it for 3 days of trade. I think when I left, the real yield was 1.54%. Now it's 1.78%. To me, the real story is the real yield, the 10-year inflation-adjusted yield, is up where all of our guests say is a tension point. Now what? What if it exceeds beyond that?
Especially because it comes at a time where there's concern about the fiscal profile of a nation paying higher interest rates and seeing the debt deficit increase, and it's raised some real questions. And then you put in an employment report, and I understand why Eddie Yardeni just wants to go to sleep, because how do you parse it through and figure out which narrative thread is the most important to pay attention?
Which narrative is most important?
It's like battle of the narratives.
That's always the case, though, but to your really important point, you got to weight a narrative that is your belief in your retirement plan, or, you know, not this babble that we do all day.
Like this decline in volume.
It's my narrative that matters, and I mean that's the key thing right now.
I can't answer the question.
Come on.
Ira Jersey can. Ira Jersey, chief U.S. rate strategist for Bloomberg Intelligence. He's probably listening to us and throwing up his hands and saying, guys, it's all about Japan. I don't know. Ira, what's driving the market right now? Because you are seeing some pretty mixed reactions on the heels of that labor market report.
Yeah, I think that the bond market sell-off this week kind of set everyone up for an okay report that we received this morning. The way that I read the employment report was more mixed, because even though wages are growing, hours worked was a little bit lower, and you know, you have had a bit of a moderation in the amount of job growth, and also the mix of jobs continues to be skewed toward the lower end of the wage spectrum. So with losses in information technology, for example, but you had, you know, increased employment elsewhere. For the market, and to Tom's real yield point, you know, most of this move this week, and we have seen a pretty decent sized move, has been in real yield, not in inflation expectations. So the market is more worried about how much supply there's going to be. We have bigger auctions next week, plus some of the global interest rate moves that are being done by the Bank of Japan and in yield curve control. European central banks continuing to be somewhat hawkish. So it's a mix of all of those things that I think has just brought the real yield up to even more restrictive levels than where they were a couple of weeks ago.
Can it stay? And I guess that's really the key question, especially right now we're looking at a 2-year basically flat on the day. You're looking at 10-year yields lower now on the day. Try to come up with a narrative and it will be rendered obsolete within the hour. Ira, how much are we looking at the possibility that these higher rates could really stay for a longer period of time, given what Eddie Ardeni was talking about, an increase in productivity, giving higher wages, and a fully employed labor force?
That's actually one of the things that we're looking at right now, Lisa, and we'll talk about this more next week in some of our research, is what happens if the Federal Reserve stays on hold, you know, not just for the next 6 months, but for the next 18 months, because that will shift the yield curve to actually, interestingly, you'll see some more bear steepening of the yield curve, still an inverted curve, but just less inverted than it is right now, and signaling that, you know, the Federal Reserve can stay on hold. Look, the way that I view it, the Federal Reserve has 2 mandates, and until one or both of them is completely out of whack,
Would have been nice if we held that small supply area there.
You're talking about needing job losses as one necessary condition, and the other one is for inflation to continue to come down modestly, which presumably it would if we saw job losses. So I think until those two conditions are met, the Fed's going to be on hold, and that might be another year and a half. We're talking about the problem with a soft landing is that the Fed is just going to be on hold.
Would be an insane move. Continue pushing up higher.
Here, on the real yield, which will really be my focus of study over the weekend and into next week, to be quite honest here, I got a 1.78, 1.80 all of a sudden. I'm at a range where most of our guests say that's it. That's it in 2006 was 2.05%. What are the ramifications if we get real yield convexity into next year, which lifts it up above 2%?
Well, if you get it significantly above 2% in 10-year yields, and I think that's just going to be end up being a sign that the market is not convinced that the federal government can reduce the size of the deficit anytime soon. And you know, a big reason that we've had this move in real yields, I think, is the supply pressures. You know, we're getting a lot more supply next week. You're talking about $3 billion more in 10 years, $2 billion more in 30 years. The market needs to have a reason to purchase that amount of duration, and some of it is structural, right? You still have insurance companies and pensions, but on the other side, how do you get investors who are looking for price return to get back into the market when it seems like the policies are just going to remain restrictive for a while?
Oh, yeah. Thank you so much. Greatly appreciate the Bloomberg intelligence there on the real yield. Katie Greifeld this afternoon, I believe, the real yield will be scheduled to see. What's your observation here, Lisa? I don't really know what to make. I mean, again, it's August. It's asleep right now. We're not asleep. We're going to continue here. John's going to have Elarian on. We're going to have a really sprightly radio discussion as well. But what do you make of this?
I think that other people are just as confused as you are, and you can see that in the oscillations of the market. I think you nailed it. I think that's exactly it. No one knows exactly what to make of this because it kind of paints conflicting conflicting pictures of a labor market adjusting to a new normal, maybe at a time when everyone's just following their gut.
My answer, corporations will adapt to 4% X yields. They will adapt and adjust as they did in 2005, for that matter in 1995 as well. This has been a joy. In the 10 o'clock hour, speaking of joy, the gentleman from Milton Academy, Austin Goolsby, the Chicago Fed. Good morning.
Economic Indicators brought to you by Commonwealth, supporting more than 2,000 independent financial advisors with the solutions they need to grow a thriving business. Commonwealth, go where you grow. Visit commonwealth.com to learn more.
Gonna be a supplier now.
Surprise that we're pulling back.
There are signs of weakness in the economy coming through.
Investors are stepping back and saying we're going to wait to see how far yields rise. What you want to see is inflation slow credibly and sustainably.
Nice sell side coming in.
Materialize, you can expect high rates for a period of time.
Bloomberg Surveillance with Tom Keene and
Gold looking for down. Don't know about that. It's very strong buy side coming in. I would not be surprised. I mean, it's come back and retested. Literally that breakout zone. If anything, I'll probably be looking at taking a long. Bam.
Momentum in the economy. Equity futures, they point to a higher open on the back of that jobs data. Yields are slightly higher. 10-year Treasury yielding 4.16%. We'll call it right now on the commodities front. WTI crude oil steady, just under $82 a barrel. Gold, it's higher, just above $1,975 per barrel. I'm sorry, for ounce there for our good friends with the gold bugs. Bitcoin, it is lower, just above $29,000 per. Coming up, we're going to chat with Jay
I'm taking a long.
Water Asset Management on the Apple and Amazon earnings. Plus, we'll check in with PIMCO's chief North American economist, Tiffany Wilding, get her thoughts on some of this.
Nah, I don't know about pulling back here on gold. There's a a lot of buy side coming in. If anything, I'd be looking at taking a long. Probably to the top, yeah. Yeah, I've got this supply area here. Found a little bit of sensitivity at.
Almost a 3% decline in Apple shares. Again, AAPL, the shares trading just shy about $186 per share. What's interesting though, Paul, and I'm going to put my macro hat on here for a second, is that you had, of course, a pullback in the products piece of it. iPhone demand is lower. Smartphone sales aren't quite cutting it. iPad, MacBook, you're seeing it across the board. Services revenue remains a blowout, which is exactly what you're seeing in the economy. People aren't spending on goods anymore. They're spending on that walk-in traffic, those services, which I think is really important, especially post-COVID, because remember when Apple store closures kind of front-ran the market in terms of just how much the COVID story was kind of circulating through the economy?
Yeah, so I mean, if you're an Apple bull, you've been hanging your hat on services for 3, 4, 5 years now.
Yeah.
That has to be the driver of earnings growth because A, it's growing faster than the products, the hardware, and B, it has a lot of high margins.
Yeah.
That's a good story.
I mean, to me, I think, do you put like your Apple Care as a part of your services revenue? Is that how that works? Because I feel you pay a fortune for Apple Care.
Absolutely.
Every trip to that Genius Bar counts.
I think about it, any incremental revenue they can charge. I'm holding my iPhone as we speak. Any incremental revenue they can charge just because I own this thing.
Yeah.
That's services.
There you go. I mean, well, it would explain why it was a blowout number, because it is, and if it's growing, then your long-term bull case is quite positive as well. Speaking of long-term bull cases, Amazon, AMZN, higher by just shy of 10% this morning. Here is your kind of big mover for the day. I'll just call it now. The market hasn't even opened yet. This is coming off of, again, some good numbers on both their e-commerce and their AWS units. What's interesting about the Amazon story is that it's never really been strong on margins.
Mate, oil's on an absolute rampage.
Always seen that top line growth, but not that bottom line growth, because they're dealing with wages. They're a logistics company, that kind of seesaw, if you will, or the trade-off, if you will, between their e-commerce business and then.
Right, I'm going to take a long here on gold.
Nevertheless, beating on both fronts, finally making those margins, and the market loving it, higher by 10% there. is your ticker.
Yep, that was the big ones last night. Busy week we had for earnings. A lot of economic data, including today. So, but again, Apple got to pull back a little bit. It looks like here market trading, while Amazon takes a big leap forward. Kriti Gupta, thanks so much for joining us. Kriti covers all the markets for us. She's our Bloomberg Markets correspondent. Face the Nation, the CBS television network, Sunday morning. Margaret Brennan is off, but not to worry. Major Garrett will be sitting in for Margaret. He joins us right now. Major, thanks so much for taking the time here to join us. Boy, what a busy week in Washington, D.C., particularly yesterday. How will you and the Face the Nation crew deal with what we saw in Washington yesterday with former President Trump?
We will have on the show one of the fact witnesses in the indictment against the former President of the United States for what the special counsel alleges was a concerted effort. The word of art is conspiracy to overturn the 2020 election. Who is that fact witness? The former Vice President of the United States.
Oil was on an absolute rampage.
He's in such a unique place there, Major.
Crazy.
Who was the last confirmed Attorney General to talk to the former President about what happened in the 2020 election.
We'll see how it plays out, but that'll be our final trade on oil. We'll let it build up on some more structure after that.
The sense that somehow he won when he lost. We'll have him on the show as well.
That basically gets to the heart of the matter with those two guests there, Major. What's the feeling in Washington now with 24 hours roughly to digest what we saw yesterday? Is this a trial that can take place before the election?
Yes, the answer to that question is yes, it can. I've talked to several lawyers who not obviously have experience with prosecuting or defending a case of this kind because there's never been a case of this kind, but who are familiar with a case in which political matters are being discussed and adjudicated. And they've said this case could be scheduled within 5 months, 10 months, certainly within that.
Very strong move from
defense attorneys would like it 3 years from now. Guess what? That's not going to happen.
From Gold.
Jurisdiction from Washington D.C. to West Virginia. I wonder how they arrived at that. That's not going to happen.
Very strong move.
What we're going to find out on August 28th, though, and this was made fundamentally clear to the former president in court yesterday, the trial date will be determined on August 28th. And the Trump Defense Counsel was put on notice. Submit all your paperwork, but we're going to decide. You better get ready for something sooner rather than later.
You know, Major, I think it's important to talk to somebody about all this mess who understands the fabric of the heartland, like working for the Amarillo Globe News a few years ago. And, you know, Major, what I find fascinating here is Republicans.
Bloody hell, markets are really going for them squeezes on either end, aren't they?
Florida, on and on, who clearly are not part of the court Trump following. How lonely are those Republicans right now? How lonely is Mike Pence right now?
Mike Pence is extremely lonely, but he has, and I think anyone looking at his language since the indictment was released has seen him somehow more forceful, as if he's been liberated, as if he knew, which of course he did, that he provided contemporaneous notes, that he testified to the special counsel. Now that it's all on paper, he's speaking much more aggressively about what the choice for him, the former president, and not indirectly the nation was. Would the Constitution be followed or would it not be? And when the former president said to Mike Pence, as a matter of a slur, you're too honest, it's now clear the former vice president wants to have the Republican Party have a conversation about what does that mean? What does that slur mean? You're too honest when it comes to something about the Constitution. So the Republicans are going to have to debate what that means or what it doesn't mean. Right now, Pence is lonely, boundary in the polls, not even qualified for the Will he get more traction? Will he be selling merchandise now with the logo, you're too honest?
How can there be any other topic at the first debate besides what you're going to talk about on Face the Nation this weekend? There can be no other topic, right?
Hard to imagine we're going to get to Medicare reimbursement rates or the future of Social Security.
Yeah. Major Garrett, thank you so much.
Alright, we got to the man zones here.
You can hear, you can see Face the Nation. I'll get it right. See Face the Nation Sunday on the CBS television network. Hear Face the Nation. Listen to it Sunday at 2 p.m. in New York, Washington, D.C., Bloomberg 106.1, Boston, Newbury Report. Face the Nation Sunday at 2, all across. Bloomberg Radio. Jobs Day.
Yeah.
You know, Paul, I thought you'd be heading out right now. You know, it's like,
Sure.
okay, it's Jobs Day.
Well, I'm coming in. It's Jobs Day.
Lift to the market in the last 10 minutes, up 0.4% on Standard & Poor's 500 after the carnage that we saw yesterday. Yields churning here. I'm going to give you the 10-year yield, 4.15% as well. With our news in New York City, here's Michael Buck.
Tom, Paul, thank you very much. Donald Trump pleaded not guilty to charges that he conspired to obstruct the 2020 presidential election and interfere with the voting rights of millions of Americans. The former president was arraigned in the federal courthouse in Washington. Trump's legal team say that they are prepared to vigorously defend their client. Trump has built his support with the Republican base with each new indictment, but Brown University's Wendy Schiller says the party as a whole may be nervous.
Might get a little bit of upside on Bitcoin.
Is this candidate capable of winning, even though polls show in the end of the day, he lost in 2020. You know, can he actually win the general election with all these indictments? And then second, what are his finances going to look like?
Wendy Schiller, director of the Alfred Tubman Center for American Politics and Policy.
Come on, oil. Push.
Federal prosecutors have charged 2 active duty U.S. Navy.
There's a nice tap of that area. Obviously, you got those 2 demand zones there. Decent amount in here. That's your structure. That's your breakout. From that range, you have come down and tested it on the lower time frame. And it could be the case that we come and retest that and then see a stronger push. Ideally sticks to this zone. Bam. And continue pushing up. That was a crazy amount of volume from the buyers. Again, as mentioned, caught out liquidity here, pushed straight back out, caught out liquidity on the top end. So it's got some clearance. It should be able to make a nice push.
Bloomberg Business and Sports. I noticed the Browns NFL Hall of Fame game. Oh, wise one. Does the season start too early?
No, you can't. Oh,
it's August 3rd-ish, 4th-ish.
My only regret is that I could not stay up for the end of the game.
Really?
No, okay, it's preseason, but it's the NFL. It has started. The Hall of Fame this weekend. Yes, I am. But this weekend, I'm going to trash out and watch a whole bunch of preseason games. I'm excited.
It's like in Pharaoh's English football thing. They're friendlies. Are these friendlies? Like, does the starting quarterback for the Browns play?
No, and of course Aaron Rodgers didn't play last night. You know, Zach Wilson, and let's be honest, Zach Wilson showed he can still move the ball.
Minute.
Yeah, this is great, man.
And they're going to be playing through February, August through February.
Exactly.
Yes, they are.
In ice hockey, this is important. Yeah. In ice hockey, the season starts October 10th. I don't care what they say. When we were kids, that was a magical day when the NHL started, October 10th. And they moved it forward, like Cincinnati Reds on opening day of baseball. It should be April 10th or whatever it is. It's not anymore. August 4th, you're watching the whole game?
I'm watching preseason. I'm getting my fantasy football teams ready. I'm watching.
That was successful last year.
Well, let's not talk about that.
How do you pick quarterback in fantasy football?
Well, I know it sounds silly, but I mean, it's like you don't. Yes, you want somebody like
Aaron Rodgers,
somebody like that, or Patrick Mahomes. Yeah, you want somebody like that, but you got to go through all the paperwork and statistics.
I did it 1 year, and they didn't ask me back. I put it Bloomberg Business and Sports with Scarlett Fu and Michael Barr as well. Scarlett watched the entire game last night. I know for certain. Futures lift. Futures up 17 on a jobs day. good job formation, lower unemployment rate in America. This is Bloomberg.
Nearly 1 in 2 U.S. adults have high blood pressure. That's why it's important to self-monitor your blood pressure in 4 easy-to-remember steps. It starts with a monitor. Be next to talk to your doctor about your blood pressure numbers. Get down with your blood pressure. Self-monitoring is power. Visit managerbp.org. Brought to you by the Ad Council, the American Heart Association, and the American Medical Association, in partnership with the Office of Minority Health and Health Resources and Services Administration.
The world is facing a water shortage, and solving it could combat climate change.
If we choose to do nothing about water scarcity, by 2050, more than 50% of the world's population will be living in environments where there's not sufficient water to sustain life as it is today.
That's Calvin Emanuel, Vice President and General Manager for Sustainable Growth Solutions at Ecolab, which helps companies optimize water use in more than 170 countries worldwide.
I think a lot of people are surprised that there is a direct correlation between water use and reduction in greenhouse gases. Water in manufacturing processes are oftentimes heated, cooled, treated, moved, and every one of those instances requires energy.
With more efficient water management, industrial companies could reduce their water consumption by up to 44% and trim their energy use and greenhouse gas emissions by double digits. Find out more at ecolab.com/water for climate.
I'm Emily Chang, and on my new show, The Circuit, I speak with the big names in tech, culture, and innovation, and ask, what's next? You'll hear from leading tech CEOs and investors, alongside influencers and celebrity entrepreneurs. This is a chance to go deeper, to meet people in their world, and find out what drives them. Watch The Circuit, Thursday nights from Bloomberg Originals. You can catch it at 10 p.m. Eastern on Bloomberg TV, and on the Bloomberg app, on Bloomberg.com. And download the Circuit Companion podcast wherever you get your podcasts.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker of the Bloomberg Newsroom with this Bloomberg Business Flash. Let's start off with yields. Yields are lower. Stock futures higher after the jobs report this morning. Payrolls rising less than forecast. That's Fed friendly. Average hourly earnings are more than expected. That's not Fed friendly, but the moderating employment picture, that seems to be the narrative that investors have latched onto this morning. By the way, the biggest percentage gainer came in the logging industry. Sure. I'm a lumberjack, and it's a tale of two techs. Apple lower, sluggish iPhone sales overshadowing strong revenue growth in China and record sales in India. An upturn in Amazon's e-commerce business, that's encouraging. That may add to sales growth. Its shares, they're getting a pop in the pre-market. S&P futures right now up 18 points. Dow futures up 83. The Nasdaq E-mini futures up 74. Two-year yield 4 basis points lower. That's at 483. We'll check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Paul and Tom.
John Tucker, thanks so much. The Bloomberg Business Flash, it's brought to you by Interactive Brokers. Interactive Brokers, they charge dollar margin loan rates from 5.83% to 6.83%. Rates subject to change. Learn more at ibkr.com/compare. Once again, ibkr.com/compare. Once again, a semblance of knowledge from Gene Munster. He's managing partner at Deepwater Asset Management, but far more than that, has been absolutely definitive on product cycle at Apple. I mentioned this, Gene, you'll laugh at me. Umpteen years ago, I was with Lawrence Haverty, legend at Putnam, Larry Haverty. And Larry and I were standing literally on the curb of Fifth Avenue out in front of Apple, and the world was done. It was ended. The product cycle would not advance. Apple would die and become a pink sheet stock on the Vancouver Stock Exchange. Gene, Larry Haverty, they said, maybe not. The fears never have gone away, Gene Munster. Let's begin with the why is that. Why have the fears always been there that one day it will be over for Apple?
It's because there's scar tissue, and with investors around